Well, it's time for another Mortgage Minute with Frank Napolitano from Mortgage Brokers Ottawa. He's going to be answering some frequently asked questions about home financing and the housing market. Good to see you again, Frank.
Good morning, and great to see you again.
Thank you. We have several questions for you, so we'll hop right to it. The first one reads like this. We've never missed any payments, but our credit scores are low due to balances that are close to our limits. Our bank has advised us that we don't qualify because of this. Any other options?
Well, depending on the timing, I would say that that's very common. So what we've seen over the last 12 months, 18 months, is that the credit scoring has become tighter and tighter, and the banks are very, very strict when it comes to credit, your credit score.
Right.
So an easy fix for this would be, it sounds crazy, but if you don't have the means to pay your credit card down, get another credit card and lower the balances. So your credit score is based on your limit versus what you owe.
Okay.
And if you're really tight to your limit, that's where your credit score comes down, and that's what we've seen recently. So it sounds crazy. Either that or else get a loan.
Right.
If you can get a loan to pay off the credit card, the loan is probably a better interest rate than the credit card itself. And then the loan, it's okay if the loan's at the limit. It's when a revolving credit facility like a credit card's at the limit that really hurts you. So that could be fixed in a matter of 2-3 months. So depending on what the timing is like, if you're looking to buy now, then I think you got to hold off. But if you're looking to buy in the spring, you've got time to fix it.
Okay. Are private lenders more flexible than the bank? Because I know the context of the bank in this question.
Well, so if it's a private lender, then yes, you might have to take an alternate lender mortgage or a private lender mortgage for a year. But if it's a first-time home buyer looking to get into the market and they only have 5% down, then the rules are pretty strict there. You're going to have to get your score up by maybe getting a loan and paying down that credit card so that you can qualify for a mortgage.
Got it. All right. Here's our next question for you, Frank. Our home equity line of credit with a balance of approximately $300,000 now has an interest rate close to 8%, and our payments have risen from $750 to $1,900 per month since April of last year. We're struggling to make ends meet. Would we be further ahead locking into a mortgage?
So that credit facility is interest-only payments. So that payment is $1,950, and that's strictly interest. Now, you could lower your interest rate by taking a mortgage by probably 2 percentage points, but your payment, if you're struggling with the monthly payment, that wouldn't work because the mortgage has principal and interest payments attached to it. So your payment wouldn't come down that much. If anything, it might even go up slightly. The only option is if you've got a lot more equity in your home and you're struggling with the cash flow, what you may have to do is maybe qualify for a higher limit. It sounds crazy because everybody's goal is to pay down their debts. But today, with the cost of everything being so expensive, we're seeing people increase their mortgages and increase their amortizations and taking longer to pay off their mortgage just because they need to just make ends meet.
Right, everything's going up. Inflation as well as increasing our limits. Okay, our mortgage matures next spring. This is our next question, and we are stressed as our payments and financial commitments already have us barely making ends meet. Will we have to sell our home in the spring? That's a huge one for a lot of people.
Again, you see questions like this. These are types of questions. People are stressed. People are really, really, really struggling to make ends meet today. In a scenario like this, I would sit down with the individual or couple and say, where are you at right now from a standpoint of equity in your home? Because what you may have to do is what I just talked about before, is you may have to increase your amortization again. So you may have a 20-year amortization remaining. At your renewal, you can increase it to 30 years, and hopefully between now and the spring, the interest rates have come down a little bit, and that's where crossing our fingers happens. But then at that point, you can maybe lower the payment a little bit. And they might be carrying some other debt as well, so therefore you can put everything in one and bring it down to one payment. We're doing so much of that these days.
Okay, perfect. I think we have time for one more. CPI inflation numbers are released today. What is expected, and how will that impact the next Bank of Canada rate decision on September 6th? I don't think people have watched these announcements so closely as they have now.
Never before. I mean, I've got it in my calendar when they're coming out, when all the job reports, the CPI. I've never done that before. So CPI report comes out today. It is expected that the inflation number will go from 2.8 to 2.9 or 3%, so go up, which is kind of crazy, but expected because we've seen fuel costs go up.
That's right.
So this is year-over-year numbers. Nonetheless, I mean, there's less than a 50% chance the Bank of Canada will increase prime rate on September 6th. but it depends on what these numbers come out at. So if this number comes out at 3.2, then that's concern that maybe prime rate will go up again. There's also a labor report, the jobs report that's coming out in a week or so.
Right.
And then that'll also have a determining factor as to what the Bank of Canada does. So we're probably 7 or 10 days away from having 7 or 10 days away from really having a good feel on what Bank of Canada is going to do September 6th.
Understood. Thank you for this, Frank. Appreciate you.
Always a pleasure, and support local businesses and charities.
Definitely.